Thought leadership from PwC's National Office.
Welcome to PwC's Accounting Podcast. I'm Heather Horn. Does your company transact in foreign currency? In today's episode, we continue our mini-series on foreign currency accounting. When a company transacts in more than one currency, preparing financial statements in a single currency requires that changes in the relationship between the currencies be recognized and measured. Maybe sounds easy enough, but if you deal with this, as you well know, it can get very complicated very quickly. But don't worry, in this episode, we help break it down as we walk you through the process of foreign currency remeasurement of FX transactions and translation of a foreign entity's functional currency financial statements into the reporting currency.
The translation process, as Ross talked about earlier, is the process of trying to report your functional currency financial statements in the reporting currency. So you get an overall perspective of the performance of the company. And so basically what the standard says is that you would translate your assets and liabilities at the period end exchange rate. Your equity items generally get translated at the historical rate, or more appropriately, the weighted average historical rate, because your equity transactions happen at different periods of time. But the overall logic behind that is we don't want to be creating CTA on equity items. Your revenue and expense items theoretically need to be recorded at the rate on the date, or translated at the rate on the date that those transactions occurred.
That was John Horan, who's joined by Ross Strucker, both specialists on foreign currency who are in PwC's National Office. John and Ross bring their wealth of knowledge and experience to the conversation. So with that, let's get started. So John, Ross, welcome to today's podcast, which is going to cover foreign currency remeasurement and CTAs. So just for our listeners' benefit, this is part 2 of our foreign currency series. And as Brett said last week, his visual would be that you would listen to the one last week, then come listen to this one, and then go back to that one because they are interrelated. But definitely you can start with this one if you need to, particularly if this is the topic of interest for you. But John, maybe go to you first just for why this is such an important topic.
Well, the remeasurement and translation process, is fundamental to the production of the financial statements. And so understanding that process, I think, is very important in terms of understanding what's going into the numbers that are showing up in those financial statements.
And again, for the listeners' benefit, John's looking at me like, this is so obvious. Why are you asking me this question? So it's all good. It's all good. All right. So now that we've established this is a very important area of accounting, maybe Ross, just to kick things off, I know that, we talked last week about the fact that a company could have the reporting entity and its subsidiaries could be conducting transactions in more than one currency, but obviously the final financial statements are in a single currency. And so you have to recognize and measure those differences. So what's the guidance and what are some of the key pieces of that?
Sure. So I know we have 2 podcasts here, right? This one in particular is grounded in the same guidance that the other one is, and that's ASC 830, which covers foreign currency matters, and originally was FAS 52, which goes back to 1981. So older than I am, unfortunately, or fortunately, depending on how you look at it.
Not older than me, though.
Or me.
and within that, there's 2 sort of distinct processes that go into the reporting and into the process here. So the first being foreign currency measurement and the second being foreign currency translation. So when you think about foreign currency measurement, that's really the process by which you take or you recognize transactions that are denominated in a foreign currency into your own functional currency. And changes in those functional currency amounts are transaction gain or losses and are recognized in net income. The second piece of that is foreign currency translation. And that's really the process in which you take your functional currency financial statements and turn that into your reporting currency. And changes in that are translation adjustments and are considered to be part of CTA, or cumulative translation adjustment, which is a component of other comprehensive income. And so each reporting period, companies will consolidate all of their operations, both domestic and foreign, and turn that into a single set of financial statements, which we obviously all look at today, and every company prepares. And so we have this other podcast that we recorded earlier today, which covers a lot of that process. And again, that process starts with the determination of what the legal entity is, and then turning all of that effectively into your own functional currency, and that will create sort of your set of financial statements here.
Heather, the way I always explain it to somebody who's new to this for the first time is the theory behind the standard is that every foreign operation converts all of their assets and liabilities into their functional currency and then distributes it as a dividend to the parent at the dividend rate. And so that's your remeasurement and your translation that Ross was talking about.
All right, that's helpful. And then obviously, because there is a difference there, that's where you wind up with this cumulative translation adjustment. All right, so that's helpful. So then with that sort of as the backdrop, Ross, sticking with you, then we talk about these foreign currency transactions. So maybe you can walk through sort of at that level, what that is, and then how we think about it.
Sure. So, foreign currency transaction is a defined term in GAAP. And I won't go into detail on what that actual definition is, but it's really transactions where your terms are denominated in a currency other than an entity's functional currency. And those can arise when you're buying and selling goods, when you're borrowing or lending funds. There's, I think, 3 or 4 different things within the definition that will effectively highlight what a foreign currency transaction is in GAAP. So, when you're thinking about the initial measurement piece of this analysis and of this process, if you will, foreign currency transactions initially need to be measured and then recorded in an entity's functional currency. And when you're doing that, the rate that you're doing that transaction or that remeasurement as of or using is the exchange rate on the date of the transaction. So depending on whether something is a monetary asset or liability or a non-monetary asset or liability, that will drive the recording of that particular transaction. So monetary assets and liabilities, if we think about what that is, right, it's really assets and liabilities that are fixed in terms of their unit by contract or otherwise. So what does that mean, right? It's effectively cash. It could be short-term or long-term accounts receivable, things of that nature. Sort of the typical things that you would think about when we're talking about what a monetary asset is. The counterpart to that, right, are non-monetary assets, inventory, property, plant, and equipment, things of that nature, right? So I think we're all probably pretty familiar with what at least at a high level, the difference between a monetary and non-monetary asset are.
Yeah, that's right, Ross. And foreign currency transaction sort of picks up where we left off in our last podcast. Remember, we spent a lot of time talking about establishing functional currency of all our legal entities, right? And so when you have your functional currency established, and we have transactions in currencies other than that functional currency, those transactions need to be measured in our functional currency. Now, those transactions can be either monetary or non-monetary. Monetary transactions are things like accounts receivable, accounts payable. So if we're a euro entity and we have dollar receivables, right, changes in the exchange rate between the dollar and the euro are going to change our cash flows as an entity. On the other hand, if we're talking non-monetary assets, let's say we purchased a piece of equipment in euro. We're a dollar entity purchasing euro equipment. My memory's not as good as it used to be, Heather. So we're purchasing dollar functionality, purchasing euro assets. Those assets are non-monetary assets. We're going to measure them on the date we purchase those in dollars, and that will never get remeasured, right? Because after we make that initial payment in euros, our cash flows of the entity are no longer affected by the purchase of that asset.
All right, I think that's helpful. And then, John, just to be clear, this talking about the measurement and talking about these foreign currency transactions, then you really are talking at a transaction level, and it's comparing that entity's functional currency to the transaction itself. So it doesn't matter if the currency, the ultimate parent, you're looking at the entity itself and then the transaction.
That's right. Said differently, right now we're at the legal entity level.
Okay.
And then later on, we're going to talk about translating the functional currency financial statements of those legal entities to our reporting currency.
All right. I'm trying to jump ahead based on our discussion from last week. So then, Ross, maybe going back to you. So we've talked about these different types of non-monetary and monetary assets and liabilities, but I know that, there's can be a lot of questions about when you should be making this measurement, and then also exchange rates to be used and things like that. So what can you share on that?
Sure. So why are exchange rates important, right? It's not just for when you go on vacation in foreign currency, a foreign country, and want to buy something for yourself. But obviously, it goes without saying, a key component of all this are exchange rates. And for many currencies, an exchange rate is pretty obvious, right? We know a Euro USD exchange rate. You can look it up. We feel pretty comfortable, or you might feel pretty comfortable that that's an accurate rate between two currencies. In other instances, that might not be the case. So exchange rate is a defined term in the codification, and it's the ratio between a unit of one currency and the amount of another currency for which that unit can be exchanged at a particular time. And so, again, when you're dealing with liquid currencies, it's very easy to figure out what that exchange rate should be. But in certain countries, there could be imposed restrictions, there could be imposed controls on those currencies, and as a result of that, it could be a little more difficult to determine, sort of what the exchange rate should be that you should be using as a company. So one thing that goes along with those restrictions and those types of issues that you might have are penalty and preference rates within those countries. And so in particular, I know, John, you had talked about it in the other podcast, if you've happened to listen to that one first, you could have countries with high inflation rates. And as a result of that, there might be significant devaluation in that currency. And so countries will implement exchange controls around that. And they can do that. And one way in which they do that could be by penalty or preference rates. So, I think the example we like to use is that in those types of countries, you might not be able to walk to the corner bank and exchange one currency for another. And the central bank is effectively putting limits, to control the currency within that country.
So basically, put a different way, I think one of the examples we used was Venezuela. If I'm in Venezuela, what currency?
The Bolivar.
Okay. So if I have Venezuelan...
Sorry, it took me a minute.
Yes. So if I have Venezuelan bolivars, I can't just walk to the bank and say, hey, give me US dollars today, or there'd be a limit on how many US dollars I could...
Probably depending on when, right? It could have been one or the other in that.
Okay.
Typically what you see in those countries, Heather, is that the central bank takes, all of that ability away from the rest of the banking structure. So that if I want to exchange bolivars for dollars in Venezuela, I have to go to the window at the central bank and say, hey, I purchased these goods in US dollars. I need some dollars in order to pay for those goods. And the central bank, will decide whether or not they feel like giving you those dollars today. That's the exchange control. They're trying to preserve their reserve of U.S. dollars, and so they manage, in some cases tightly, how much can get out and for what reasons you can exchange.
All right. And so then what happens, Ross, in those cases? What do we see as side effects of that?
Yeah. So in some cases, you could have a black market for certain currencies. And when you have that, the U.S. GAAP explicitly prohibits the use of black market rates to measure and record foreign currency transactions. So that's obviously one thing to be aware of and to think about, and obviously a big no-no, so to speak. And then oftentimes these countries manage what they'll call the official rate of their currency versus another. And won't allow that currency to float or fluctuate with other currencies that are in the market. And so many countries may introduce preference rates as a result, or penalty rates, like we talked about a couple minutes ago. And those rates are established by the central bank of that country and are subject to certain requirements. And if you think about why those rates exist, a preference rate will be favorable compared to the official rate, and a penalty rate will be unfavorable, as the name sort of suggests. But it's really meant to discourage a company from doing certain types of transactions in that particular country. So, in the case of a penalty rate, right, you're really discouraging a company from declaring a dividend and getting money out of that country into, another country. And in the case of a preference rate, it's really, trying to drive a different purpose, right, and encourage certain transactions to occur, including having money come into that particular country.
So then to that point, if I go back to John's example that I'm trying to get US dollars to purchase these goods, maybe they give me an official rate, But if I'm saying, hey, I'm going to try to send all my earnings to my parent, they'd say, sorry, you can't trade at the official rate. We're going to give you much less than
exactly.
Okay, so then how do you think about that when you're actually recording your financial statements?
So Ross, one of the things I think, for example, I think we saw this in Venezuela when Venezuela went highly inflationary, is they would allow a company who was importing, let's say, baby formula. Nobody wants the babies to be hurt, right? No. So when they're importing baby formula, the central bank may allow a more attractive U.S. dollar Bolivar exchange rate in order for them to incent to import that baby formula. And I think you mentioned dividends. They in Venezuela, for example, they really weren't interested in exchanging currency for companies that wanted to pay a dividend back to their parent. So there's either a penalty rate, and even at a penalty rate for trying to make a distribution to your parent, they still may not have allowed that exchange to happen. That's how strict stringent some of these exchange controls can be.
Yeah. And I was just going to add, if we take a step back, right, we're talking about penalty rates, we're talking about preference rates, we're talking about highly inflationary economies and exchange rates as a whole, right? Why does that matter for the accounting? And when you have foreign entities in your own company that are in these jurisdictions, what you need to think about is whether or not I can use these rates, right, to actually book transactions, whether that be remeasurement like we've been talking about, or eventually we'll get into CTA and the translation impact, the translation of a company's financial statements. But can I use those particular rates in these countries, or for that matter, what rate should I be using in these particular countries when I'm thinking about remeasurement and translation? And so that's really what we're getting at here, that we're highlighting these different things that may impact you as a company, and that should raise a red flag in your head. There's 10 different rates here. There's 3 different rates here. What's the right one to use? And you have to look at the facts and circumstances. And I think that's where, you get to a situation where we've talked about this as an old standard. It's pretty understood what you should be doing, but the gray area lies in how do you actually apply it when you have a moving market and things of this nature going on.
Yeah, although I guess it's interesting because this is the interesting part of this conversation, but for most measurement, it's going to be fairly straightforward. It's going to be a rate. I mean, maybe there'll be like a few cents different, depending where you're transacting, but it won't be that complicated to figure out the rate. But clearly then there are situations like the ones we're talking about where it can be very complicated. And I guess in some of those cases then, John, you can wind up where you actually have alternative exchange mechanisms that you need to think about as well.
Yeah, we've seen this in different economies. And the reason that they exist, first of all, usually when there's a high inflationary environment and stringent exchange controls, you will see a black market, as Ross mentioned. Black market rates cannot be used for U.S. GAAP accounting purposes. So they're illegal rates. We don't allow the use of illegal rates. These alternative mechanisms could be legal mechanisms. And so we get questions all the time about, hey, this alternative mechanism exists. Should I be using this rate to record transactions? And many times, that rate is not as attractive as the country's official rate, right? So CFOs begin to worry about, how reliable are my financial statements if I'm using this official rate? But these alternative mechanisms, the reasons they exist is because, remember, the whole idea behind the exchange controls is for that country to manage their reserves in US dollar or euro, for example. And so if they just don't allow any conversions of their local currency to US dollars or euro to pay for goods that country needs to import so that the economy can live, the companies will stop importing the goods. You'll have, and that, is not a good situation. No. You'll have shortages of things, and, we know that's not good. And so what they do is they allow these other mechanisms to exist. So one that we get lots of calls on is in the country of Argentina, there's a mechanism called the blue chip swap rate. And what the blue chip swap rate is it's a mechanism, it's legal in the country, where I can take Argentine pesos, purchase a US dollar denominated Argentine government bond onshore in Argentina, transfer that bond offshore, hold it for a period of time, and then sell that bond offshore for US dollars. And the buy and sell of that bond leads to an implied exchange rate. And so we field a lot of calls that say, should I be using the blue chip swap rate to record my transactions as opposed to the official rate? And so far, we've looked at that and said no. Although it is a legal mechanism in the country, there's a couple of reasons. One, there's a holding period on the bond, and so you're exposed, the purchaser of that bond is exposed to market risk, and that's not insignificant in Argentina on that bond. But more importantly than that, they've actually reduced that holding period over time. It used to be 5 days. Now I think it might be down to 2 days. And so they've reduced the holding period on the bond. There's still market risk. But more importantly, there are laws in the country that say that market can't be used to circumvent the normal exchange mechanisms with the central bank in the country. And so for those reasons, we've looked at it and said, we don't think that's a rate that is appropriately used for measurement purposes.
All right, that's very helpful. So then I guess I'm curious maybe from both of you before we get into translation, do you see, obviously there are some places where there's questions about exchange rate and what you should use for measurement, but do you get more questions about something like that or about translation?
We get them both, but I would say in terms of which exchange rate and how to record transactions, probably more in terms of measurement, but we get both.
Yeah. Ross, how about any perspective from you?
Yeah, I think, I've been back with the firm for a couple months here. And so there have been a number of questions, around exchange rates. And I guess we also see the offshoot of all these things, which eventually will lead into hedging and how do I think about the exposures and all that, right? Which I know you've had probably many podcasts.
Although it's always a good topic to do another one. Maybe I'll have to get you and John back to do that. John and I did one, but it's a good topic.
Yeah. So that, the derivatives and hedging impact, for a particular company is obviously all driven by everything we're talking about here today and creates the exposures that a company will look to hedge. So there's knock-on impacts to everything we're talking about here today as well.
Yeah, and I think it's always helpful to think of this more, why the accounting, how it fits into the economics. So that's helpful. So, all right. So then with all that said, let's assume we've measured. Then can we talk a little about translation?
Sure. The translation process, as Ross talked about earlier, is the process of trying to report your functional currency financial statements in the reporting currency. So you get an overall perspective of the performance of the company. And so basically what the standard says is that you would translate your assets and liabilities at the period end exchange rate. Your equity items generally get translated at the historical rate, or more appropriately, the weighted average historical rate, because your equity transactions happen at different periods of time. But the overall logic behind that is we don't want to be creating CTA on equity items. Your revenue and expense items theoretically need to be recorded at the rate on the date, or translated at the rate on the date that those transactions occurred. I think many times you'll see companies using average exchange rates for the period to translate revenue and expense items, but that's only appropriate if that approximates, the rate that should occur on the actual date. We're going to talk a little bit about practical expedience in a little bit, but that's the translation process. So we're translating into the reporting currency the difference between the exchange rates at the beginning of the period and the exchange rates at the end of the period, and they end up in your translation adjustment.
All right, I have some questions, but let's do the practical expedience because that may cover my question.
Okay. We get lots of calls about practical expedience on here, and sometimes some of the practical expedience that I hear about can get quite exotic, I guess is the word I would use. But the standard does say, that it sort of goes into literal application of the standard would imply that you have to use the exchange rates on the date the transaction occurred. But it does say that practical expedience can be used as approximations, right? So my overall comments when you're talking about practical expedience is, yeah, it says you can use practical expedients, but they have to approximate, what those figures would be had they been translated on the date that the transactions occurred. It's not a free pass to do whatever one wants to do. The other thing I would say is this comes back again to the fact that this standard was written in 1981. In 1981, I think the personal computer was in its infancy, let alone things like the enterprise resource planning systems that companies have today and the more robust consolidation systems. Those systems, as I understand it, do have the ability to translate those transactions at the rates on the day that they occurred. So although we see practical expedients being used, I think when entertaining the use of that practical expedient, we need to really understand why that's necessary, particularly in the computing environments that exist today.
Yeah, I think companies historically had a practice, right, that maybe they were using even a balance sheet rate that perhaps wasn't exactly on the last day of a period, right? But some of that years ago was necessary, right, in order to be able to actually close the books when you needed to.
Yeah.
And to John's point, I think I've at least seen some companies over recent years adjust their previous policies because, to your point, the treasury systems that they have today allow them to be able to do things on a more timely basis, and they have live feeds, and you could look up the rate today and have it and see what the impact is. So I think that's one thing to just think about as you're listening to this podcast. Do you have policies and procedures that may have been put in place years ago, and in some cases many years ago, that might make sense to sort of think about, should we as a company be doing something differently? And I think a lot of that is also just driven by the fact that anytime you have a rate that's different from what GAAP in theory tells you to do, or you're making a practical expedient or an accommodation, you're creating noise and potential risk that you're using a rate or showing a value on your balance sheet or your income statement that's different than really what it should be reported as. And in some cases, for liquid currencies, the rate may not fluctuate a ton before a period end or over the course of a month, but in other ones it does. And you could have a significant difference in your balance sheet or income statement just by using a date even a day earlier or 2 days earlier than you otherwise should have.
Yeah, I think it's great advice. And it definitely shows how things are evolved, right? In terms of what you need to think about. So I think it's very helpful from both of you. One question, John, before we go on. I know we talked about, assets, liabilities, revenues, expenses. How about things like goodwill or other things that maybe aren't even recorded at that foreign entity level?
Yeah, goodwill's and certain other intangibles, is interesting because goodwill lives at the reporting unit level, which of an organization, which may be higher than the foreign entity level of an organization. Is an area where maybe the nomenclature doesn't work and play so well together. And so it's important, especially when you go out and acquire a foreign operation, to make sure that you put, even if you're only recording the goodwill at the reporting unit level, it's important you understand how much of that goodwill relates to the various foreign entities that you've purchased. Why is that? Well, because that's an asset of that foreign entity, and in theory, it needs to be translated into the reporting currency, creating cumulative translation adjustment on that goodwill. If you don't push it down to the foreign entity level, you're not doing that, and that's an issue. I mean, the standard specifically, speaks to this issue. So we get that question a lot.
All right, so something you can anticipate and maybe avoid problems later if you treat it right at the beginning. And I guess speaking of acquisitions and dispositions, then I know we've created CTA, and there are situations where CTA is released, including acquisitions and dispositions and others. But maybe starting with that, Ross, what happens then when there is an acquisition and disposition to the CTA?
Sure. So again, maybe level setting, because we've been talking about measurement, we've been talking about translation, right? CTA is created as a result of the translation of financial statements and will sit, at the level above that foreign entity, right, as the translation occurs. And, you can have CTA build up in different entities throughout an organization, right? So just to be clear, it doesn't necessarily have to be at the top parent entity that we're talking about here. But like we said, ASC 830, requires you to release CTA when there is a sale or complete liquidation of an investment in a foreign entity. And again, that's in the standard. You can go look up what the explicit words say, right? But like the way to think about it is if you sell or completely liquidate or substantially liquidate an entity, right, then you potentially have to release CTA, or at the very least think about whether or not you need to release CTA. And so one thing that this comes down to, I think, or as a baseline is, John and Brett had talked about identifying what a foreign entity is. And that's really important for this, because the only way to actually understand whether or not you need to release CTA is to understand which entity are we talking about here that is being sold or liquidated. And that seems like a very simple thing to think about, right? But in reality, it can become complex when you're talking about when you're talking about large organizations, multinational organizations that have a lot of entities, and in some cases, the entity may have been set up many years ago. So that's the basis for determining whether or not you need to release CTA. And, in the cases of a subsidiary, does that entity being sold meet the definition of a foreign entity in the standard, right? Like those types of things we need to think about. And so when you're talking about releasing CTA, if control is lost, right, then 100% of the CTA is released as part of the gain or loss on sale. And if control is not lost, then CTA is not released. So that
none. You don't. It's not like an allocation. You just say full stop. None.
If control of an entity, and equity method is a little bit different, but at least for a foreign entity, if you do not lose control of that entity, then CTA will remain.
This is one of those things that changed when one of the BizComp standards, I think it was 141 maybe.
Oh, okay. I feel better that I was confused.
So yeah, this is one of the things that changed when when they issued a new BizComp standard. It used to be in the old days, some would say the good old days, that when you sold, let's say from 100% ownership to 80% ownership, you would release 20% of the CTA. That standard changed that. It was all about loss of control. If you lose control, you release 100% of the CTA.
All right. I feel better, although for our listeners' benefit, the standard happened quite some time ago, but I don't deal with foreign currencies. So
yeah, and the other thing, so that's the entity sort of foreign entity side of this thing, right? But if we're talking about equity method investment, if that's sold, then CTA is released on a pro rata basis related to that entity.
All right, that's helpful. So let me ask one more follow-up question, though, because we talked about this scenario where your foreign entity is made up of maybe 5 different operations. And what if you sell 100% of one of them? Do you release the CTA related to that, or like that?
That's the magic behind identifying your foreign entities, like Ross was talking about. So in that situation, and Brett talked about in the other podcast, where we have 5 fast food restaurants, that we decided, even though they're 5 legal entities, they're really one foreign entity. If we sell one of those fast food or restaurants, that's just an asset of the broader foreign entity. So you would you would say, well, unless that asset, that legal entity that we sold was, Ross is going to get to this when he talks about substantially complete liquidation, was more than 90% of the assets of that entity, you would not release CTA.
Ah, very helpful. All right, well, maybe we should talk about then the substantial or complete liquidation.
Yeah, so I think to that point, right, if we're talking about a complete or substantially complete liquidation of a foreign entity, what does that actually mean, right? We're talking about someone selling the net assets of a particular entity. And so to what John was saying, if we sell 100% of the assets of a foreign entity, then I think it's pretty obvious you would release 100% of the CTA associated with that foreign entity. Now, what if you cannot sell 100% or don't sell 100% of that foreign entity's assets? Typically, I think like a lot of things in accounting, we look at 90%, sort of as a threshold here, right? And you view the sale of 90% or more of an asset of the net assets of a foreign entity as substantially all or substantially complete liquidation. And in those situations, if you sell 90% or more of the assets of a foreign entity, then you would release 100% of the CTA associated with that foreign entity as part of the gain or loss on sale. Maybe I should say that 3 times faster. And then, but again, like if you're selling 90% or more, you release 100% of the CTA. Now, when you're talking about how you come up with determining whether or not you've met that 90% threshold, we look at it on a fair value basis, not a book value basis. And again, in GAAP, lots of different places you do different things, but at least for the purposes of this, we look at fair value. Another thing is, what happens when the assets of a foreign entity are being sold over time, right? I think we can all probably look to different, either if you're at a company or if you're at another firm, you're thinking about, all right, sometimes these things just don't happen immediately and you're in one swoop, sell everything. And so you would typically look to, sort of your plan or documented sort of liquidation plan to figure out whether or not you've achieved sort of substantially all liquidation based on the net assets of that, plan as you documented.
All right. So definitely a lot to think about. And I definitely seems like it could get confusing. But any other areas that you would see that you would think that clients and engagement teams may need to focus on?
Yeah. So one thing I think that has come up over the years, and John and others can probably attest to it, is that what happens if I have a transaction, the assets of an entity are sold, but the cash that you raise as a result of that sale is not immediately, sort of sent or paid back to the parent. And again, this is one of those situations where we have a standard that's pretty explicit on what you should be doing, right? But the complications come from when the transaction is different than sort of the black and white normal transaction. So in those types of instances, we would want to think about why is that happening, right? Is there a regulatory angle to it? Is it tax reasons? Is it because the parent wants to reinvest cash into the local entity, right? So all those things come into play when you're determining whether or not, you should release CTA as a result of the sale. And so one of the things that we would typically ask is, if you are planning to reinvest that cash locally, is it going to be reinvested in a similar business? And if the answer is yes, that it might not be appropriate to release CTA because you haven't really, you might have liquidated the net assets, but you're effectively going to reinvest into the same type of thing you were doing before. And so CTA, it's probably appropriate not to release that. Another question we're often asked is whether or not a subsidiary is liquidated by selling all of their assets to another subsidiary or a related party, if you will, right? And an intercompany liquidation, if you want to call it that. And in that case, there would be no CTA release either because, on a consolidated basis, you haven't liquidated anything.
Yeah, we get that question more often than you would think.
Yeah, I mean, it seems like it should be obvious, but I guess it's good to make sure.
Well, people are reading the standard, and it talks about liquidating an entity, and
you liquidated your entity. Yes.
But you got to look at things on a consolidated basis.
Well, and I guess it goes. Oh, go ahead, Rob.
No, I was just going to say the other thing too is FX is one of the unique areas in GAAP where intercompany transactions, although they're eliminated, in some cases there's FX impact to it that potentially exists in the broader financial statements, right? So sometimes those types of things pop into someone's head as they're thinking about unique transactions. And in other places in GAAP, you might say, this is intercompany transaction and everything's wiped out. But in the FX space, that might not even be the case. And I mentioned derivatives before, but there are times where you could be have intercompany transactions that arise to that create FX gains or losses that you might even be able to hedge. And so it's a unique thing in the FX
Okay,
space.
it's fair. That's good. That's good defense for the people that are asking these questions. So, John, how about from your point of view? What have you seen that may be like some of these tricky areas to think about?
Yeah, one area that's a little bit counterintuitive is when we do a step acquisition. So typically when we release CTA as part of the gain or loss on a transaction, it's because we've reduced our exposure to a particular currency. In a step acquisition, we're actually increasing our exposure to that currency, or potentially increasing our exposure to a particular currency. But the way that the step acquisition works, let's say we own 30% of a company, we're carrying on the equity method, and we buy another 30%, so we get control. All the CTA that we've created on that equity method investment gets released. And we start anew as a new controlled, consolidated entity. The logic behind that is it's as if we paid two things for the purchase of that controlling interest in that business. First, some cash or equity or whatever it is. And secondly, an equity method investment at fair value. So that's the logic behind the release of the CTA in the case of a step acquisition. And that's something that's not necessarily intuitive.
So, John, just to clarify that point, though, if you had 20% and you bought 10 more %, and so you're still equity method, that you don't
No.
do this release.
No.
It's only in this case where you're moving from equity to control.
Yeah.
Okay.
It's from significant influence to control.
Okay.
Yeah.
That's very helpful. And then how about any others that you'd highlight?
Yeah, there's one other area, and I'd have to say this is a sleeper. People forget about this sometimes, and that is, let's say we haven't sold our foreign entity. Let's just say we're talking about selling a business that's a foreign entity. But we plan on selling the foreign entity, and it meets the definition of assets held for sale. Well, when we have assets held for sale, we have to do an impairment calculation. Now, it's possible that those assets, or that foreign entity has accumulated CTA over time. So one of the things that the standard doesn't want is for us to do an impairment on the foreign entity, and then 6 months later, when we actually sell it, have another loss potentially or gain, related to the release of the CTA from equity on that transaction. So what the standard says is that when evaluating those assets held for sale for impairment, you need to include the CTA as part of your investment. Because if you think about it, what did we do with the CTA, right? We as we were translating that reporting entity into our functional currency, we were, most of the time you're talking about writing it down. If there's something to business, we were, writing down the investment in that entity, but not putting it through P&L, putting it through CTA. So combining the two when doing in the impairment effectively eliminates, so you get one impairment loss in theory. I mean, it could.
Right, but I mean, the logic.
One impairment loss rather than having two hits in your P&L at different periods in time.
All right, that's helpful. So definitely a lot to think about here. I guess maybe two final questions, Ross. First, where would you go if you wanted to know more? Because clearly, if you're dealing with this, probably a lot of questions.
Sure. So PwC obviously has a foreign currency or foreign exchange guide where a lot of today's topics have been discussed in more detail, and a lot of it's included in Chapter 5. So I would recommend everyone to go there. I think it's pretty nicely laid out, and you can kind of see what some of the basis for what John and I talked about today is.
Yeah, and good examples in that guide too.
Absolutely.
So, yeah, and then of course I know John knows, but Ross, hopefully someone warned you. I always like to wrap things up by asking for some words of wisdom that you would have for companies and engagement teams dealing with these types of issues. So maybe Ross, I'll go to you first.
Sure. And I think we've said this throughout, but this is a standard that has not changed very much, right, in many years, and so the way. To me, that means that 90% of whatever you're trying to do, whether it be translation or remeasurement or anything sort of FX related, with the standard, is probably going to be relatively straightforward, right? So we're talking about the 10% of these types of transactions where you really need to take a step back and think about, all right, like is this a foreign entity or not, right? Like, is there a problem with an exchange rate that I should be thinking about? And perhaps I need to be thinking about alternative rates or just other things that will impact me as a company. And so, policies and procedures are great, but this is an area where, depending on what's going on in the market, it will really impact what you do as a company and ultimately your accounting. So I would recommend everyone just kind of keep an eye out and make sure you have the appropriate sort of controls in place to monitor the market and see if at least anything from an exchange rate perspective is going to impact you. And then also just have a sort of working relationship in your organization to think about, are there situations that are going to be coming up, whether that be an asset sale, the sale of an entity, a unique transaction or anything like that, where it should raise a red flag to you as an organization that you need to take a step back and, something might not be a black and white transaction that falls into that 90%. So,
all right, that's helpful. John, how about from your point of view?
I agree with what Ross said, but I think it's also important to get the right level people involved in some of these decisions. Functional currency decisions, the foreign entity decisions, hey, did we just sell a foreign entity? We need to release CTA decisions. People who understand the business purpose behind what's going on, as well as the accounting. This all tends to be part of the consolidation process, and there might be a massive accounting department, responsible for getting that done. But it's important, I think, to have, that strategic perspective on what's going on. And I think more likely to get the right answers if you do that.
Yeah, I think that's helpful. I guess the one thing that really stood out to me from talking, other than the thing about if you're disposing of a company, but also this idea of making sure you're really using the right exchange rates and not to just, 20 years ago you were using an average rate,
Right.
and that's what you're still doing. And I do think there's cases still where a process has been in place a long time, so maybe it's a good idea now to relook at that. So appreciate that. Thank you guys both for the advice, and thanks again for joining me.
Thank you.
Thank you.
That's our show for today. Tune in next week for more fresh episodes. So that you never miss any of our audio content, follow the PwC Accounting Podcast wherever you listen to your podcasts. And to stay up to date on all our latest accounting and reporting news, sign up for our newsletter at viewpoint.pwc.com. From Thought Leadership at PwC, I'm Heather Horn. Thanks for tuning in.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates, and they sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors, including accountants and lawyers.